Welcome, everyone. So if you don't know me, I'm Navar, the founder of Navexa. I've been in touch with many of you over the years via our support channel. So hello to all the people that coming back for more. So today's session, of course, is going to be all about tax. And the end of financial year is literally upon us. Tomorrow will be the last trading day of the financial year, which I just realized earlier today. So this is a really good time to start thinking about your portfolios and how to get them ready for tax time coming up. So we're going to cover everything you can do with Navexa to speed up and simplify the tax reporting process. So I'm going to start with all the basics, and then as we get further on into the process, I'm going to start showing you some more advanced features around tax loss harvesting, a few SMSF features, and the manual parcel selection feature, which is one of the ones I'm most excited to show you because a lot of people are unaware that we even have that feature. And for those who are aware, they may not know how to use it. So we'll have a demonstration of that one as well. So like I said, going to cover the basics and we'll work our way through. Tom's on the call, as you can see, and so he'll be in the chat, so you can message him. He'll try and answer any questions as we go along. There is a Q&A feature in Zoom that you should be able to see down the bottom. If you could post questions in there as we go, I think it allows you to upvote on them as well. So when we get to the end of the session, we'll just simply, I'll try and answer as many as I can, going through the most upvoted down. Some disclaimer stuff. So the usual disclaimer, this is not financial advice or tax advice. So some of the CGT strategies and things I'm going to show you, completely up to you which ones that you want to use when doing your tax. And if you've got any questions about that stuff, definitely ask your tax professional or accountant for advice on that one. So if I could get, just as a gauge here, if people could drop a thumbs up in the chat if they're already a Navexa customer, and that will just give me a gauge of how many people we've got here who are existing customers. If you can't find the thumbs up, yes, we'll do. Very good. So we've got a whole bunch of people who are already Navexa customers. If you're not a Navexa customer, could you drop a smiley face in the chat? Just want to gauge, see what I should cover in terms of some of the basics or not. Cool. So we've got a few smileys coming through there. Awesome. All right. So very nice. SS Cruise here. Well, good to have you, and we'll hopefully convert you by the end of this call. All right. So on that note, tax time. Let me get my shared screen sorted. Share. Okay, cool. All right, so just so we're all on the same page, I wanted to discuss a couple of basic concepts, and one in particular, which I get this support question a lot more than I expected, but what is a portfolio in Navexa? And the easiest way to think about a portfolio is think of it as a tax entity. So as an individual, you file a tax return, so you would have a portfolio for your investments. So it doesn't matter if you have 3 different brokerages and a crypto exchange and all sorts of things. They all go into the one portfolio so that you can do your tax return on that portfolio. So I know a few people who might have different brokers, like to get different portfolios and put different brokers into each one. And while you can do that and you can run tax reports for each broker, you then kind of have to mash them together yourself at the end to file your tax. So can be done, but not optimal. So just think about it, create a portfolio for each tax entity. So if you've got an SMSF, there's another portfolio. If you've got a company or a trust, there's another portfolio. So keep that in mind as we go, and that might help you set up your account. So This is the main portfolio screen in Navexa, and I've got a portfolio here with a whole bunch of stuff in it. So we've got a whole bunch of ASX holdings, some cash accounts, a bunch of crypto, some managed funds, and we've got some US holdings as well. And I wanted to drill into, excuse my cough, it's the one I warned you about. I wanted to drill into 3 different holdings to show you the trade makeup, which will be quite relevant when we go into the tax report shortly. So if we take a look at this BHP holding and have a look at the trades. So this BHP holding, there was an original buy trade here back in the year 2000. So quite a while ago now. A few corporate action events, then DRP or dividend reinvestment plan was turned on in 2018. So there's a bunch of DRP trade adjustments you can see here. And then in this financial year, back in March, there was a sell trade for 500 shares. So note, this sell trade doesn't close the whole position. It is only selling part of it. So that's later when the CGT strategies come in. I'll show you the effect of that. Jumping back here, we're going to look at a VAS holding. So VAS is a super popular ETF here in Australia, and I think a large portion of our customers hold VAS in their portfolio. Now, VAS is quite a common one for new investors, and particularly in this scenario, there's 2 concepts that are quite common I wanted to talk about. One is dividend reinvestment plans, and the other one is dollar cost averaging or DCAing, which is a fantastic strategy for a lot of people. But what a lot of people don't understand about dollar cost averaging is it comes with quite a huge administrative burden, particularly when selling stuff and doing tax, which I'm going to demonstrate here. So if we just have a quick look through this before we move on. So as you can see, there was a buy trade for $500 back in 2013. DRP was turned on. So there's a whole lot of dividend reinvestment adjustments here, and a lot of them are zero because they didn't have enough balance to actually convert to a single share. But it's tracking the balance all the way through. Then you got 1 share, and then we're tracking the balance all the way through again, and then you got a share. So our DRP tracking does the balance tracking as well. Then there was another buy trade, but where it gets really interesting is here at the start of 2023, I've simulated what dollar cost averaging would look like. So in a $1,000 trade, 1 for every month for the entire year with DRP on, you can see this opens up a hell of a lot of buy positions. Now that's only after 1 year of DCAing. So you can imagine after 3 years, for example, you've got 36 buy trades in there. After 5 years or 10 years, you've got a whole stack of buy trades in there. So if you start selling some of those as you go, you need to think about, well, which CGT strategy am I using? How am I keeping track of that? So in 5 years, when I sell some more, I know which parcels I sold back in the past. That's where DCAing gets quite complicated, but a tool like Navexa makes it super easy. Now, the last one I wanted to show you is this Bitcoin holding. So crypto, whether you love it or hate it, a lot of people are getting some crypto, especially buying into Bitcoin or Ethereum. So I thought I'd give you a quick example of what that looks like and how the tax reporting works as well. So in this Bitcoin example, we bought some back in 2022. And then earlier this year, we traded some Bitcoin for Ethereum. Now, what a lot of people don't understand is a coin-to-coin trade triggers a CGT event. So you might not be getting any cash because you're just getting more coin, but you do have to pay tax on it as if you did get some cash. So we have those 2 in here that we'll have a look at in the tax reporting a bit later on. Excuse my hoarse throat. All right. So without further ado, we'll jump into the tax reporting. So up the top, we've got a tax reporting menu. We're going to start at the overview section. will change to 2024. So, surprise, surprise, the tax overview is an overview on your current tax position. And what it shows you at a glance is what your capital gain or loss is so far for this financial year, and what your total investment income is so far for this financial year. So this is really useful to check in on this page periodically throughout the year, particularly if you've been selling stuff, because you may not want to get to this point of the year where there's one trading day left and realize that you've incurred a huge capital gain and you now have to come up with the money on how to pay that tax. So this overview is really good for just keeping on top of, am I running at a gain or a loss this year? Do I need to do anything about it? You will notice on the side panel here, we've got this concept of being tax ready or tax readiness. And what that is simply we do some validation on your holdings, your trades, your dividends, and staking rewards if you have any. Well, excuse the cough. And we flag up the top here if there's anything that needs addressing. So in this case, you can see a message saying you have issues that you need addressing before your tax reports will be ready. Now, these issues are more of a guideline, so you don't have to action them. You can still run the tax reports, but this is just warning you that you might want to look at some of these things before you do it, just to ensure complete accuracy. So in this case, it's saying that there's 7 dividends that need confirming. So if we click the fix button, it'll take us to a version of the all dividends report filtered down to the 7 that we need to have a look at. So I'll change to no grouping so that we just get a nice list. And essentially what you want to do is go through here and make sure that the values are correct. Did you receive the amount that it says? Is everything good? And then you can simply click confirm on the side and they will go away. So as you click confirm, those are getting confirmed behind the scenes. Looks like the server woke up. And you finish, all dividends are confirmed. You go back to the tax overview, and now we get a nice green message saying there are no issues, you're tax ready. So this is a concept we introduced, I think last year, just to make sure that you can come to this page and be confident that everything's good to go. When I run the tax report, everything is fine. So the next thing I want to do is show you the capital gains tax report. So let's jump in there at the moment. So this is it's one of my favorite reports actually, because as an investor, particularly an Australian investor, tax is a huge part of your investment performance. And if you ignore tax and just do trades willy-nilly, you end up losing a lot of the gain that you worked so hard for just because you simply made a few silly decisions rather than some tax efficient decisions. So up the top, you select the financial year. So we've selected the 23-24 financial year. We get a nice summary up the top here, which breaks down how the capital gain is calculated. So in this case, you can see we've got a $12,500 capital gain. And then underneath it breaks down the gains into their respective categories. So you can see the long-term capital gains. So we've got that BHP holding I showed you earlier, the Bitcoin holding, there was a CSL one, but the VAS one is here as well, and some capital losses from the Bitcoin too. Now, what a lot of people don't realize is that there's more than just the FIFO strategy when filing your tax return. Now, FIFO, if you don't know, stands for first in, first out. And it means when you do a sell trade, you calculate the gain based on the first trades you bought and work your way through. I recently did some videos on YouTube for all of our different tax strategies, so we'll send a link out to all those afterwards. But if you're interested in how the strategy works, check those out. I go into some detailed examples. So I want you to remember this $12,500 capital gain figure. We're going to go into tax settings up the top here. And what we've got here is a few things. So here you can change the CGT strategy at the portfolio level. So we've got first in, first out, or FIFO, last in, first out, LIFO, and then we've got minimize gain and maximize gain. You can also, at an individual holding level, choose the different strategies as well. So you might say for BHP, we want to do LIFO, but for everything else, do FIFO. So that's completely up to you what you want to do here. Let's change, though, from FIFO to LIFO. So last in, first out simply means when we do the sell, we're going to use the last buy trade first and work our way back through the trades in that order. So remember, 12,500, we'll update the settings. And now the capital gain is 9,800. So we shaved off nearly $3,000 in capital gain simply by changing strategy. And you can see down here, now all the records are showing LIFO, and we've got quite a few more parcels visible now for BHP. Remember, we had one before. Now there's a whole heap. And that's because of all of those dividend reinvestment positions that were opened. They all now get processed first because they were the last ones in. So LIFO is probably the second most popular strategy people use, because usually the last shares you bought have a price that's similar to the ones you sold. So think, if you owned a stock for 10 years, chances are the trade you did 10 years ago will have a much lower price than what your sell trade is today. Whereas for that same stock, if you bought some shares last week, chances are that price is pretty similar to when you sold today. So LIFO often results in a smaller capital gain, but not always, because as we know, the market can be pretty crazy. So the prices can swing wildly up and down on certain things. So let's take a look at another strategy. So we'll change to the minimize gain strategy. Now, what the minimize gain strategy does, instead of processing things in date order, so FIFO goes from the start all the way through to the end, and then LIFO is obviously the reverse of that. Minimize gain orders all of your buy parcels by price, particularly the highest price first goes out. So if you do some basic maths, the highest price on your buy trade versus your sell trade is going to end up giving you the least gain. So let's update to that. And now our gain's even less. So now it's 7,400. So remember, we started at 12,500 with FIFO. LIFO gave us a $9,000-ish gain, and now minimize gain has dropped that again to 7,400. And you can see the breakdown here of all the different parcels that the minimize gain strategy has used in order to come up with this gain. So you can see there's a bunch of losses here and a whole heap of long-term capital gains in there as well. Now the final one, maximize gain, is obviously the opposite of min gain. So we sort all the buy trades by price again, but we're processing the lowest price shares first. So if we change that, that gives us a $13,000 gain. So there's plenty of scenarios where you might want to make your gain the biggest it can be. I'll let you and your accountant sort those scenarios out. But basically, what I've demonstrated here is there's 4 completely different ways of calculating your capital gains tax, and comes with 4 completely different outcomes. So depending on what you're trying to achieve, you've got quite a bit of wiggle room here to make some good decisions on how you want to file your tax. So that is kind of the gist of the CGT report. You can obviously export everything to Excel or PDF up the top. But the next one I want to show you is the next main report, and that's the taxable income report. So you can get to that from the menu up here. Click taxable income. We're going to look at the 23-24 financial year. So straight away in this report, we have the summary, and you can see in the summary, we have all the tax codes here, which line up with the ATO form when you're filing your tax return. So you can see the first item here is crypto income. So there was some staking rewards on the Ethereum holding, which I didn't show you, but you can trust me, there is staking rewards on the Ethereum holding. And then under that, we've got some cash interest payments on the cash accounts we had in there. And then you can see the income derived from dividends. So, or your unfranked amount, your franked amount, franking credits, all of that good stuff. And then further down, income from partnerships and trusts. So that's all your ETF income that shows up here, and any foreign income as well. So we had a couple of US holdings in this portfolio which generated foreign dividends. So they show up here. If we scroll down a little bit, this is where we get the breakdown of all of those figures. So non-trust income is all of your ordinary shares. So you can see we've got our BHP holding in here. Couple of dividends paid from BHP. So you can see the net and the franked amounts and any franking credits. It's all visible there. We keep scrolling a bit more. The trust income. So this one's an interesting section. This is where your ETFs show up. Now, if you own ETFs, you may be well aware of the fund admin that comes with ETFs at tax time. And that is because they pay out distributions throughout the year, but they don't come with any tax information just yet. Then after the end of financial year, the ETFs release their tax statement that they send to all of you who own the ETF. And in there is a whole bunch of figures like any cost-based adjustments, if there's any foreign income tax in there, all sorts of cool things. So you can see we've got these buttons here saying enter statement component. So for VAS, for example, you can click that button, which launches this pop-up, which I definitely need to style to be a lot nicer. But regardless of the style, it works like this. So you can see down the side, we've got codes that match up with a lot of the codes in the statement that you receive. And so if there was like an AMIT increase, you can simply put the value in here and you can see it makes the pro rata adjustment across the distributions that you receive for the year. And then you fill out all those fields, you click save, and that will update all the values on your ETF income there. Further down, so we've got foreign income. So we had a US ETF that paid out some dividends here. So we see the foreign tax withheld, all the cool information there. Any cash interest payments show up here, which would usually be a bigger list than just one, but this is where it appears. And then crypto income as well. So that's your staking rewards. So Ethereum had some staking rewards. Usually there'd be a whole stack of staking transactions that would appear in there if you were actually staking Ethereum. So that shows up there as well. We'll go back to the top, and again, you can export these to Excel and PDF as well to send off to your accountant. All right. So the next thing I wanted to show you is a new form that we did last year called the ATO My Tax Report. What we tried to do here is make a report that lines up as close as possible to the ATO My Tax form. So if you're doing your own tax return, you can run this report and all of these headings on all the different fields line up with the headings on the ATO My Tax report. Now, one cool feature that's unique to this report is if you have a certain capital gain for the year, there's a certain threshold, I forget, I think it might be $10,000. The ATO wants you to do a breakdown of how those gains were calculated. So this area is now expanded. So you can see under here, it asks for shares in Australian listed companies. What's the gain? What's the loss? If you have other shares, what's the gain? What's the loss? Units in ETFs, gain and loss, and that kind of thing. So that section perfectly lines up with the ATO My Tax section, which is very useful. And then under it is the same taxable income codes that you can see in the taxable income report. So this is kind of just a high-level summary of the exact fields that you need if you're doing your own tax return there. I apologize about the cough. It's annoying me just as much as you, trust me. Let's have a look at the historical cost report. So that's kind of covered all the basics. So for a whole heap of investors, those three reports will see you through tax time. These next reports, this one's more specific for SMSFs, but the next one, the unrealized gains report, which I'll show you, is where tax loss harvesting comes in. But we'll get to that in a second. So the historical cost report or the inventory report gives you a nice summary of all the holdings you have in your portfolio, which CGT strategy you're using, what the opening balance is, if there are any purchases or sales, any capital adjustments, closing balance, closing market value, and what quantity you have left. So this really helps at reporting time, but particularly around SMSFs. And there's a few features so you can include and exclude brokerage and that kind of thing as well. And then from there you can export to Excel file if you would like. But unrealized gains report. Now, a lot of people don't know how to use this report effectively. So what I want to show you tonight is what it's used for and how to effectively use it. So remember in our capital gains tax report, we had various strategies, and on the FIFO strategy, we had a $12,500 capital gain. Now, tomorrow is really your last opportunity to do any tax loss harvesting, if that's what you want to do. And what that means is when you have a capital gain, you can go through and find some stocks that if you sold would incur a capital loss, and that capital loss can be used to offset the gain. So if we have a $12,500 gain, like we did with FIFO, if we can find $12,500 of losses and sell those things tomorrow, that would negate the gain and would end up having no capital gain at all. So that's where tax loss harvesting comes in. This report isn't the sole thing you should make the decision on. Obviously, there's a whole myriad of reasons for why you should keep or sell something. All this report is doing is simulating if we sold everything on this date, which is today, what would the capital gain or loss liability be? So you can see for this portfolio, if we sold everything, we're looking at a $78 or close to $79,000 capital gain. And underneath it gives you the full breakdown of every parcel from every holding in the portfolio and if it's going to be a gain or loss. So if we were doing tax loss harvesting, we're obviously interested in the capital losses section. So I'd come down here, I would order it by loss. Excuse me. Order it by loss and think, can I sell enough stuff to get $12,500 worth of losses? So you can see we've got 3,800 here, a couple of thousand here, a bunch of positions there. Overall, it's a $13,000 loss if we sold all these things. Oh, let me just pop a lozenge. I'm struggling here. So, Tom, you might have to take over for a second.
I can certainly provide some filler chat for the airwaves while you attend to your respiratory emergency. Guys, the questions that are coming in are really, really good. Navaz's still got a little bit to go once he manages to breathe again. But it's going to be really important that we get the votes in on these questions because there's a lot of them coming in. They're all really good. Some of them are a little bit more complex and specialized than others. So really when we get into answering them, we want to first and foremost answer the ones that are going to be the most beneficial for the most of you. So obviously at the moment might be a good time as we take a brief intermission.
I'm back.
I gets back on deck.
Sorry about that.
And let's all give Navarre a virtual collective smack on the back to get him through this final stint. Take it away, man.
We're nearly there. Nearly there. Just got to keep it together. Okay, so that is how you do capital losses. Similarly, if you wanted to find your biggest gains, you could come in and find them in here as well. So there might be some scenarios, like when running the maximize gain CGT strategy, where you want to find the biggest gains to get rid of them in a particular financial year. So that's why this report is super powerful. And it's very powerful throughout the year to ensure that you're making tax efficient trades. So you can really check before you do a sell trade of what the implication is going to be. So the last thing I wanted to show you was the manual parcel selection. So if we come into our BHP holding and have a look at the trades, in here you can see we did a sell trade for 500, and there's a whole heap of positions that we can sell here to play around with. So if we click on the sell trade, that expands this little panel underneath, and you can see here that we can add a new parcel. Now, if we look in the drop down, this shows us all the different parcels of that we have underneath here. And you can see that original one is 1,069 instead of the 500. And that's because there's been a couple of corporate action events, those bonuses that have boosted the quantity up. So what we can now do is some cool things like select this. Now, bear in mind, we're selling 500. We can put in 250 here and save the parcel. So how it works is when the CGT report runs, it will prioritize any manual parcels that you've done, just like this. And then if there's quantity left over, it'll go back to the portfolio default setting. So we've selected 250. Let's jump back to the capital gains tax report and have a look at this here. So you can see now there's an entry for the manual parcel that we did for 250. Because we're still on the maximize gain strategy, it simply just sold the other half of that original 500. But if we change to, say, the LIFO strategy, you can see now that we sold 250 from that original buy trade, and then the remaining 250 of that sell trade has been allocated through the last in, first out strategy. So it's a bit of an advanced method, and there's plenty of different ways you can use it. It's quite useful for when you're importing your data from a different platform and you've been doing some interesting tax strategies in the past. It allows you to kind of get your holding into the right position. But going forward, I know some more advanced investors are doing some really interesting tax strategies, and that just gives you the power to go full manual mode and do things exactly how you'd like them to do. So there's definitely scenarios that, like I just demonstrated, where you allocated half the holding to your biggest gain, and then you let the other half of the holding do the LIFO strategy. That's quite a unique combination of things that you could potentially do. So that is all the different tax features I wanted to talk about. I think there will no doubt be a bunch of questions. I haven't looked at the question section yet, but yep, I can see a bubble with 36. So there's going to be some interesting stuff in there. But I hope that kind of details most of the tax functions that you can do in Navexa and really demonstrates the power of some of those reports, particularly if you've never looked at the unrealized gains report before, for example. It's very underused, but in my opinion, it's a report that pretty much all investors should be using. If you're going to be selling, why wouldn't you want to know what your tax obligation is going to be before you sell? I think too many people are trading in the dark there, and that report really helps you bring things into the light so you can make a very good decision when selling things. So, without waffling on anymore or coughing my lungs out, let's look at the Q&A session and see what we've got here. So there will be a recording. Here's one. So will any more crypto exchanges be added to Navexa? We kind of do those on a demand basis. So we've got a feedback website at feedback.navexa.io, and you can lodge feature requests there. So if there's a particular crypto exchange you like, chuck it on there, and then make sure you encourage people to upvote that. So the more things get upvoted, that's how we prioritize the backlog. So go and check. Someone's probably already posted about the particular exchange you're interested in. Again, why is SwiftX not in Navexa? That's probably the next one we would do, because we've had a few people. I see that's had 6 upvotes in the chat. So we'll definitely be looking into SwiftX soon. Can I create a view-only option to send to my accountant to pull view data? Yes, you can. So that's a great question. So in Navexa, you can share access to portfolios. So if you click the portfolio and come to the Manage Portfolios page, if we wanted to share this particular one, stocks and crypto, the one we've been working on, you can click the Actions button and go to share. This is a Navexa Pro account, so it's slightly different than what you would see, but the gist of it is the same. You select the portfolio you want to share, you put in the name and email of who you want to share it with, and you can give them read-only or read and write access. So it's really useful to give access to an accountant, particularly read and write access to an accountant as well, because that will allow them to run the reports and make any adjustments that they need to, particularly if they want to be changing CGT strategies and things like that.
Hey, I'm gonna call out a couple of questions to you because we've got some very highly voted ones.
Okay,
so Steve asks, and this is 10 votes, realistically, is it necessary to check dividend transactions? How often are they wrong? I usually just accept all without really checking. And Steve, I can relate with this, so this is legitimately gets my vote. So how do you predict the dividends and why would they be wrong? So there's a couple of things to unpack in that one.
I can also relate to that because that's generally what I do too. But every now and then there's like some rounding error issues, and that can put things off, not by much. It's often by a few cents, maybe $1 or $2 if it's like a large dividend. But we get our data feeds from the ASX ultimately. So those are usually accurate. We've only ever had the odd occasion where something's been off, usually a rounding issue. The ETF ones, like I mentioned, get updated after the end of financial year when they send through the AMIT statements. So that's when you would generally want to check and update your ETF distributions. So yeah, I think that about answers it. But like I said, you don't have to confirm them at all. The tax report will still run with the data that's there.
Okay, so Steve is currently leading the best questions. This is also from Steve. How often can CGT strategy change, and how do you advise the ATO? Can each portfolio or tax entity have its own strategy, and can that change each financial year, or can each stock have a unique CGT strategy? I think you sort of answered that a little bit in the demo, but maybe we could just address that again.
The short answer is yes to all of those things. So you can have a different CGT strategy for each financial year. So you might start off doing FIFO, which is pretty common. Most people start there. And then you do LIFO on the next one. Then you could do min gain on the next one, and then FIFO in the next one. That's where the meticulous record keeping comes in. So if you use Navexa, then all of that's already handled for you. If the ATO ever audited you and said, prove that this gain is correct, you can simply load the tax report and be like, here is the records. Where people get stuck is when they're not using a tool like Navexa and they're not good at record keeping. They might have used a FIFO strategy like 15 years ago, and then now they forgot, oh, which parcels did we actually sell back then? And then that's when it all becomes a mess. So you can have different CGT strategies. That applies also at the holding level. You can have different CGT strategies per holding, per financial year as well. The proof for the ATO is in the record keeping. So you don't have to notify them of the strategy when you're filing the tax return. You simply file the gain or loss. It's if they come and audit you, they'll want you to prove that those figures are correct. And that's when you then produce these tax reports that show this parcel was sold on this date for this gain with the strategy you used. And that's kind of your proof there. So hopefully that answers your question. There's a few parts to it. What
Okay,
else we got?
stand by. We have, I believe, sorry, there's like quite a few questions
Very
floating
good.
around now. But okay, so anonymous attendee, when trading US stocks, does the ATO accept the exchange rate used in the system to calculate the currency impacts for capital gains or losses? That's a good question.
Yeah, it is a good question. There is a page on the ATO website, which I'll try and track down the link for when we send out an email. And they've got some guidelines on the exchange rates that you can use, because it's quite hard to pin down the exchange rate in some cases when you're selling. Certain brokers don't tell you the exchange rate and all sorts of things. From my understanding is they're happy to accept one that's close to the average exchange rate on the day. So obviously if the exchange rate was like $1.20 and you come and say, oh, it was $1.70, they're going to have a problem with that. But from my understanding, if you were like $1.21, that's kind of within a margin of error. But definitely confirm that with your accountant. I'll try and dig up that page from the ATO as well, which explains all the rules around that.
Okay, I'm going to hit you with this is a 2 question for a combined score of 13 votes. So first, John asks, do you reconcile your records with the ATO? And then Ray asks, with dividends, the record date in Navexa is always 1 day different from the date on the actual dividend statement. Why would that be the case?
Yeah, this is a common one. So the ETF income is reported on the distribution date, which is usually 1 business day before the ex-dividend date. So there's always these distributions, I think particularly VAS, that report right on the cusp of the financial year. And we've got a little tooltip on those ones that explains why it's in that particular financial year. But that's why, because of the distribution date being the day before the ex-dividend date. Whereas non-ETF income is categorized by the payment date. So quite different depending on whether you're working with ordinary shares or ETFs.
Okay, 1 asks, is it possible to change the sale allocation method from 1 financial year to another and still see what you have done in the past, e.g. 1 year minimize gain and another year maximize gain? That's an awesome question, because as we know, there's like these cascading variables that what you do in the past dictates what you can do today, right?
Exactly. So here's a good example. So this is financial year 22-23, and you can see it's running the minimize gain method here. When we change to 23-24, you can see this one is running the LIFO method. So once you've locked in the settings for a particular financial year, they're here for good. So if the ATO came knocking and said, prove what you did last financial year, you can come back, run the previous year and go, this is what I did. Here's the record showing that we did a minimized gain strategy. Here's the date, here's the gain, etc. And like on this portfolio, there's a big history. So you can go back to any particular financial year and run the report. It's using the strategy that you saved for that particular financial year.
Awesome. Okay, so I reckon we've got about another 10 minutes or so. So we've got time to get through quite a few more, and there's still some reasonably high voted questions. Leonardo asks, how are the capital gains calculated for shares in US dollars? Also for the dividends, what exchange rate does the program use? I think you kind of touched on that, but maybe we could just clarify that for Leonardo and the voters there.
Yeah, so you'll notice when you add a US share, let me just show you an example. Tesla, that'll do. So when you add a trade on a US share, if we edit that one, you can see that an exchange rate is set here. Now that is very important for the capital gains tax calculations. So when they get calculated, we use that exchange rate to calculate what the Australian dollar amount is, and then we calculate your capital gain that method via converting it to AUD and then calculating it. And these exchange rates, which kind of touches on the next question, these exchange rates are an average for the day. And we'll find that ATO article and send it out, but that falls within that margin of error of what exchange rate you're using. Some brokers will provide the exchange rate, which is very useful because when they execute the trade, they're using whatever exchange rate they're using. So plenty of brokers, when they send the contract note, have the exchange rate on it. And in that case, that's the exchange rate we use. So try and keep that as close to or exact to what the broker tells you. Some brokers don't tell you at all, and that's where we have to use an average for the day. Next question.
Okay, this is another one from Juan. Is it possible to see the capital gains tax or income tax on the sum of multiple portfolios?
No. So we don't do tax reporting at a portfolio group level. So if you're unfamiliar with portfolio groups, that's when if you have multiple portfolios, you can create a group and view it as an overall view. So we don't do tax reporting at the overall view level because all the sub-reports could have various different CGT strategies, and some of those sub-portfolios might have the same holding. So if you had 3 portfolios and they all had BHP in them, and each portfolio had a different CGT strategy on each BHP holding, that makes calculating it at the group level kind of misleading because it would display a figure that isn't actually like usable in the real world. Whereas when you're doing tax reporting on your portfolio, the figure that you're getting is usable because that's what you file with the ATO. So at the moment, if you wanted to do that, you'd have to run the CGT report for each portfolio and then kind of mash it together yourself. Yeah, that's the short and long answer of it.
Okay, Mohammed asks a really good question. What is better, minimize gain strategy or manual parcel selection? And Navar, you have to keep your answer to like 60 seconds or less because I know you're going to want to go off on that.
What is better? I can't tell you. That's up to you for what you want to use. Basically, the manual parcel allocation, you can replicate any of the CGT strategies that you like. So that would be going full manual. It's all on you to choose the right parcels. Minimize gain, like I was saying earlier, simply just processes them in order of highest price first, all the way through to lowest price. So really depends on what you're trying to achieve. If you're trying to minimize your gain, then minimize gain is obviously a good strategy to run. The most simplest, you just turn it on and it does its thing. If you want to get very specific about how you're doing things, that's when you'd use the manual parcel allocation.
Okay, we're going to do three more. These are the three remaining kind of substantially upvoted questions. So
Excellent.
John asks, if one held shares more than 12 months, then only 50% CGT on profit is payable. Is that valid for selling as well, as in only 50% CGT loss? I'm not sure I entirely understand that question, but does that make sense to you, Navexa?
Basically, the CGT discount applies when you've made a sale, so a CGT event's happened, and the parcel that you're selling is older than 12 months. So that's pretty much all there is to it. So if you're selling a more recent parcel, then you won't get the discount. If you're selling a parcel from a couple of years ago, then you do. And you can see when you run the capital gains tax report, the CGT concession amount shows up here. So that automatically factors in the long-term capital gains getting a discount, the short-term capital gains being less than 12 months not getting a discount. And then with capital losses, the CGT discount doesn't apply because it's a loss. So it only applies to the long-term capital gains.
Cool. Okay, Alan would like to know, is net capital losses from previous years captured anywhere?
That's a good one. So the short answer is no, because the reason we decided to do that is because we've got no visibility over whether you use those losses or not. What we are going to build, and it won't be ready for this financial year, but it will be for next one, is a feature for capturing your capital losses and tracking them going forward. So I imagine it will be, and I'll put a feature request myself on the feedback website, and we can definitely go into detail on what that will look like. But I'm thinking it'll be some kind of button up here. It opens up and shows you all the capital losses that you've booked from previous years. And then that will let you say, actually, I used all of that one. That one's still good. I used that one on some investments that I'm not tracking in Navexa, which is one of the reasons why we don't do it, because you may have applied it to capital gains you got somewhere else that Navexa has no visibility over. So yeah, the short answer is no. The longer answer is it will be handled over the next year.
Cool. Okay, so Hendrik asks, I have two portfolios, brackets, two brokerage, that I separate due to different purpose / fund. Do you think it's better to combine them into one so I can get consolidated tax reports? If I have the same ETF in those two portfolios, would I still be able to distinguish them?
Yeah, so it's better to have one for tax reporting, because otherwise you're going to have to run two tax reports and then kind of mash them together, particularly if while you have the same holding on two brokerages, if they're both under your personal entity, they're both kind of the same thing anyway. So when you combine, if you had two BHP holdings, for example, one in one and one in the other portfolio, when you combine the portfolios, you'd have to merge those as well. So you can't have the same holding twice in a single portfolio. The way to then group them because the next question I get is, well, how do I group them from in the portfolio from a performance point of view? And that's really where our custom grouping feature comes in. So you can go to manage groups and create a custom group, and then you might make a thing called like strategy 1, and this one will be strategy 2, and then you can allocate the different holdings into the different strategies. And then when you're on, yeah, we don't want to save that. Then when you're on here, you can select the particular custom group that you used, and that will then break down those groups here in the portfolio section. So that's kind of the best way to do it. So you get the best of both worlds. You get one portfolio for tax reporting, but then you can also split them out for performance reporting as well.
Cool.
How are we doing?
Okay, so that's going to be all the time we have right now for questions. But Kieran asks, can you please email on non-answered questions today? So we can definitely put together some content, whether it's video content or email content to send out. There's obviously a lot of complexity with this stuff. A lot of people have questions. I think before we kind of wrap up and sort of circle back to you guys in the next couple of weeks with more of this stuff, it'd be awesome if we could get a show of hands in the chat. Like if we were to run just a Q&A session, for example, in the next month, would you find that useful? Maybe just chuck a thumbs up in the chat. If so, we've had a really good turnout for this, but if it's going to be useful going forward to come in and ask Navar questions and walk through different scenarios, then just let us know. Okay, a lot of people.
we'll definitely do one. What I might do is, I think we can save the Q&A. I might actually record a video tomorrow and just try and go through as many of them as possible. And then we'll send out an email. We're about to start building out a YouTube channel as well. So definitely go and subscribe to that. It's pretty empty at the moment. There's some good videos in there on the CGT strategies, but go search Navexa on YouTube, subscribe so we know that you're interested in that kind of content. And then this webinar will be going up on YouTube, and we'll send a link out to that as well. And then I'll record answers to as many questions as possible and chuck that on YouTube as well. Really appreciate you guys turning out. It's so cool to see the chat going off. We don't have like we don't have a chat facility within Navexa, so it's exciting to see Navexa customers be able to communicate with each other in the chat. So really appreciate you guys coming. I apologize for my moment where I had to leave the webinar to cough. Hopefully that never happens to me again, but that makes for a good story. And yeah, any questions that aren't in the Q&A or I don't end up covering in the video, it's always really easy to get in touch with me by sending a message to info@navexa.io. Don't bother emailing me to my personal address because it gets so much stuff now that things just get drowned out. But if you send it to our info box, it goes into the ticketing system and then it won't get lost and I'll be able to answer all your questions. So hope you enjoyed that, and we'll do some more. Do some more webinars soon. So yeah, thanks for attending.